Hello and welcome. I'm Robert Sumnall. I'm sat with Ravi Lockyer, Head Analyst at CSS Investments. Ravi, hello.
Hello, morning.
This morning we just wanted to cover roughly what was going on with regards to the Fed rate rise, one of the most talked about topics probably of this year at the moment. Ravi, let's get straight into it. In terms of the Fed rate rise, obviously it's been one of the most forecasted things or speculated things this year. What sort of factors are different in this quarter to determine the Fed raising the rates as opposed to the previous Fed meetings?
Well, I think on this occasion the conditions were broadly similar to September. You may recall September there had been quite high expectations that the rate rise would happen. In fact, they delayed. Since September there have been quite a lot of information really detailing unemployment still falling quite sharply. Unemployment declining means that demand pressures in the economy are increased. When demand increases in the economy, in the normal course of events, inflation increases in the economy. So the conditions were changing and had changed considerably by September. Since September there's been more confirmation of those trends in place. The slowing global economy does not appear as yet to have slowed down America. So really this time was they had left it as long as possible, probably even too late, but they had left it as long as they were willing to leave it to raise rates. So they really had to raise rates now, and they flagged it very well in advance. They really had to do it on this occasion because I think their credibility was on the line.
Okay. More on what the USA has actually done.
Yeah,
what have they done with this rate rise?
Well, the federal funds rate, which is the rate that guides the money markets, was increased by 1/4 of a point. The rate moved up to a band of 0.25 to 0.5, which is a midpoint of 3/8, from a previous band of 0 to 1/4, which was a midpoint of 1/8. That rate had been in place since 2008. That has now shifted up, and they've provided guidance over the next year to expect a gradual tightening of another 1%. So that would imply 4 rises of approximately 1/4 point in the course of the next year, which would leave rates at the end of 2016 at approximately 1 3/8%. The discount rate, which is the rate that the Federal Reserve lends to banks, was increased by 1/4 point to 1%, and we would expect the discount rate to be increased as well. Further, the accompanying wording suggested a gradual tightening of interest rates, and one that would be data dependent as usual. But the fact that the board was unanimous in lifting rates gave the sense that the consensus is certainly that now is the time to make a move ahead of what's expected to be higher levels of inflation over the course of the next year, as the deflationary impact of oil prices drop out of the measure and inflation readjusts to the new environment. So a lot of things were said here. I'm trying to take care not to read too much into them, but an important point to note is that the Federal Reserve balance sheet is not being changed. The management of the balance sheet has stayed the same. The 4 trillion odd of bond securities held at the Federal Reserve is not going to be wound down yet. They'll continue to reinvest coupons and principal payments into new mortgage and agency bonds, which will leave the balance sheet at the same level. So this is designed to do primarily not to spook the bond market that there will be a lot of bonds for sale from the Federal Reserve, but also to ensure that the yield curve is managed so that the economic recovery continues on track. In the past, when you've seen interest rates rise sharply, there's been abrupt changes in credit demand and declines in bond prices. It appears the Federal Reserve is moving only very slowly to avoid any change in credit demand or any material falls in bonds.
In terms of the sort of impact that it has had on, say, the T-bonds then, or even the US equities, what has happened just in light of the news we've sort of received from 7 p.m. this night?
Well, there's only been a very muted response so far in the bond market. The 30-year bond was unchanged, which 30-year bond is especially relevant because that's how mortgages are priced in America. So if the 30-year yield remains unchanged, that means that people with floating rate mortgages do not face an increase in their interest expense. At the short end of the curve, the move was also very muted, with only very, very small 1, 2 and 3 basis points move in either direction, which is sort of the normal variance on an average day. So the movement in rates does not reflect, in bond yields, has not been abrupt in any way in any place on the yield curve.
A lot of news articles sort of reference the UK sort of mirrors or sort of closely follows what the US central banks do, about 3 months sort of lagging behind. Do you feel that the UK will be following suit with what the US has done in terms of raising their base rate? The UK, is that something that we could see, or?
I think that the rates will rise next year, but I think they'll probably be dependent on performance of the economy in the next few months. It could be the case that the situation here is that inflation is almost zero and is not expected to rise sharply. At the same time, the slowdown globally has had a lot more, arguably, and in Europe, has had a lot more impact in Britain than it has had in America. So there are a number of headwinds facing our economy, which is we're more of a petro currency as well. There are more issues facing our economy that would suggest the need for caution than in America. For example, there haven't been these large declines in unemployment recently, as there have been in the States. The Bank of England also has to be careful, given what's happened in Europe, with a number of countries having negative interest rates. If there are rapid rate hikes in Britain, that's likely to send the pound up very sharply against European currencies, which could damage the export side. So I think there are far more issues that we face that could mean that we're decoupled from what's happening in the States, and it's not likely that we'll move in step with them. I still think there will probably be a rise next year. There's likely to be a rise, but I don't think it will be in step with what's happening in the States specifically.
Okay. And although it may not be immediately clear, is there any sort of indication of who a winner or a loser may be from the Fed rate rise?
Okay, well, so far banks have been heavily bought this morning. This is because after the move by the Federal Reserve, a number of US banks kept their deposit rates unchanged. So they're not paying any more to customers, but they've lifted their lending rates. So that would increase the net interest margin of US banks and other banks operating in dollar-linked currencies, and that would strengthen the bank's operating performance. I would expect that banks are beneficiaries of last night's move and the implications of what's going to happen next year, which would help net interest margins. Losers, I think, if we look more broadly at what's happening, whilst there has been a muted response so far, I expect there will be a response over the course of the following year, and that may be to dampen consumer sentiment a bit, as more money is devoted to paying fixed costs such as mortgages and financial costs. So I would expect to see consumer stocks take on board that factor. More budget devoted to financial expenses.
Okay, great. Well, Ravi, thank you very much for your time this morning. Hopefully that answers any questions. If there are any more, leave a comment, ask us, and we will try and get back to you. Ravi, thank you very much.
Thank you, and we'll have a more in-depth report on this on our website shortly. Thank you.